the 22nd of October 2023, the bond market. I want to explain the bond market. I'm not sure if I'm wise to put you to all this bother, but one part of my channel is to give you information that I think you probably will get nearly nowhere else unless you pay for it in a university or something, and to give you an idea, because you're hearing this on the media and they're spouting out of them, and neither the ones talking about it nor the people listening have a clue what they're on about. Governments are partly financed by taxes, of course, but also by lending, by taking in money as loans. They're funded by what they call bonds. In other words, they put the hand out looking for someone to give them money, and that's called selling a bond, whereas in actual fact they're begging, the same as if you go into a bank with your cap out, you're begging them. But they don't use this term for the Secretary of the Federal Reserve or anything like that, or the Governor of the Bank of England. They don't do that. To put a bit fancier, oh, I sold 10 bonds today. So that's it anyway. US Treasuries, English, British Treasuries, and European Central Bank Treasuries, and all of that. Okay. Now the US is the reserve currency, and lots of countries invest in it. And it's, for oil producers, it's very often the case that they have all this surplus money and they have to put it somewhere. And the American government is one way to keep in with them in one sense, and the other way is to have it somewhere safe. Now the Russians thought that, and I haven't got the full figure what they had in there. I think it's 300 billion, and I think the US robbed that over sanctions. I think they took that, and that's never going to be paid back, and that's given the US government a great boost. Just the same as if you break into a house and steal somebody's money, you can have a good time and have a meal and all of that. Now the next thing is on the treasury or the bond is the yield. That's the interest, and that's paid every year for the term of the bond. That's paid every year. So the term will be the number of years, and that can be a month, 2 months, a year, 5 years, 2 years, 10 years, 30 years, whatever. And you have a thing called the inversion of the yield curve. And then you have the currency value and how that's affected. You have the banks holding low yielding bonds, and you have bailouts and bail-ins. Now, a bailout is where an external party like a government puts in money to stop a bank collapsing. A bail-in is where the bank takes their depositors' money to stop it collapsing, and that happened in Cyprus in 2008 or 9 or around there. Are you okay? Now, so the bond then has a serrated edge. This is what it looks like. It's embossed paper with a green with a kind of a goldy thing or blue, and it's made look real good. It's just whatever the printing press turns out. And it will have the amount, in this case it's 1 billion. It'll have the US Treasury written on it. It'll have the term, which is 10 years, and this is the symbol at here, at 4%. And then it'll have the coupons down along the side. I've torn off one here, you see that? So this each year will be on the coupon. So if you take it out this year, 2023, they'll tear off this coupon and they'll send you the interest, 4%. Okay, the next year they'll take it off again, and they'll send you the interest again, 4%. And it's not compound interest. You get your percentage every year. It doesn't lie there and add up. It's simple interest. And there you go again. And then as you go on down, they'll come to the end. That's that. Now, I'll not tear all these out now, but just imagine they're all gone. Once they're all gone, the next thing is they have to refund you this amount of money here. You understand that? They have to refund you this amount of money here. You with me on that? I hope you understand that. So you get your money back and the interest, if you're lucky. Now, the thing is here, the inversion of the yield curve. And essentially, investors will expect to get higher interest for long-term bonds, long-term lending, than for short-term lending. You understand me now? Because they're without the money for a longer period, there's a greater risk. So that's normally the long-term yield will be at, we'll say, the black line. Normally the short-term yield will be at the blue broken line. Do you see that? It'll be a bit less, okay? That's normal. Now, when you get inversion, you get the long-term yield dropping down and the short-term yield going up above it. And that's an inversion of the yield curve. Do you understand that now? That means that investors are a bit jittery about the long-term prospects. The bloody thing might all collapse. You wouldn't want it to happen. It could be awful trouble. So the government has to pay more to get short-term money. Government has to pay more to get short-term money. They already have the long-term in there, so they need the money up front, and we'll pay a bit more. Do you understand that? And that is a sign of a recession coming. And we'll have a look at the current situation in the United States, and I'll just show it to you here and hold it up. Maybe you'll be able to read that, and maybe you won't. Maybe you won't. There you are. So the 1 month is currently 5.421%. 5.421%. The 1 year is 5.42, a little less than the 1 month. The 2 year is 5.071. See that there? It's a little less. The 10 year is 4.914, and the 30 year is 5.078. Now I know I'm not holding these up to you too good here, but I'll just pick an example. The 1 month is currently 4.21. Sorry, God, I got that wrong. Oh, Genie man, please excuse me. The 1 month is 5.421. 5.421. The 1 year is 5.42. So if we take it, these are the same. The 1 month and the 1 year are 5.42%. Okay. Now if we go down now to the 2 year, we find it's really only 5. See that there? 5.071. It's really 5% if you round it off. But if you go to the 10 year, it's 4.9. See that there now? Hold that there for a second. 4.914, is it? Yeah. And then the 30 year is still high, because that's very long-term money. That's 30 years. That'd be for specialised funds. That'd be for people who keep trusts for children, or to have money in the future, or some person maybe who left a big legacy in 1932, and it's kept in this. Do you understand me now? And then the interest is used to keep the fund going. So it's still below. So if you look at these, if you look at the bottom, the ones on the bottom, they're all below what the ones on the top are, more or less. Do you see that now? That's the point at the moment. At this point, you'll get it on the internet there. That's an inversion of the yield curve. And here is it drawn out. Here's it here drawn out. You see that bar chart? So here, this side here, on my side here, is 1 month, and then you go over then to 1 year, and then 2 years, and you see here at 10 years is the second last one. Do you see the way the longer term bonds are making less money than the short term bonds? Understand that? And that's what's known as an inversion of the yield curve, and it's normally taken as a sign of a coming recession, because the markets are great judges. Now, sorry for my phone ringing there. Now, so one of the things about the bond market is that there's nothing stopping you, if you own a bond, of selling it, right? So we'd say you have a bond. Say you have this one here, which is a 10 year, and you have half of them gone, 1, 2, 3, 4, 5. So half of them are gone. You've got your 10% for 5 years now, or 4% for 5 years, and you can sell it now, you see, to somebody who will give you something for it with the interest. But if you are stuck for the money, you might take less than the face value. That's 1 billion. Is that what I have there? 1 billion, yeah. You might take a little less than that. You might take 0.9 of a billion. If you're stuck for the money, and the next that buys it, and he gets the bit of a profit, he can hold it for another 5 years, and he gets this interest. That's selling a bond. That's when you sell it. Now, the Asian Quick Take site has a lot of talk about the Chinese dumping bonds. As far as I can figure out, they're not dumping them. They're just not buying rollover bonds. Are you with me now? So that's how you can sell. Now with the current situation, when the bonds were bought at 2%, because during that, you know, that thing with the needles and the mass and all that, and all of this, the government kept interest rates low in America and in the world to try to stop businesses going to the wall, so they didn't have to pay back big interest. Do you understand that? Now, That's all right. If you put your money into Big Three Bank and you're only getting, they were sometimes charging you to keep your money. Sometimes charging you. And it nearly meant that if you took out a loan, you got paid to get the loan, which was mad, really. Right? You see that? Now, however, if you have your money in that bank, and now you can get 5%, right? We just see what you can get. You have your money in that bank at 2%. So now these are the current prices I've already shown you. But if you bought this bond in 2020, let's say, you might only get 2% for it, maybe 3%. Now you can get now you can get here for 2 years, you can 5%. So what are you going to do? You're going to pull your money out of the bank and put it into a bank that will give you the 5%, that will buy new bonds. That leaves the bank with a liquidity problem. It has a liquidity problem. Where is it going to get the money to pay you? And what happened recently in America is that the Federal Reserve bought back the bonds at their face value. In other words, they lost nothing. So if this is the way the bank was with this bond, and the pounds are at the door looking for the money and you have no money, the Federal Reserve bought this off you at its face value, and then you could pay your investors at least some of the money. That is a bailout, indirectly a bailout. Nobody said it in the news. It didn't happen to every bank, but there was an effort to get big banks to bail out the small ones. But you're hearing it now on the first time from real true education, not fake news. That has already happened. That's a bailout, effectively. So a bailout has already happened. And you see the inversion of the yield curve there. So you sell your immature bond if you want to, and someone else buys it and hopes to hold it and make money. And this rollover concept, when the bonds are up, when they're mature, where do we see where they're here? So when all these are gone and you've got your 4%, when all this happens, they then have to send you a check for 1 billion. They have to pay you that, unless you're Russia. They won't give you anything, and the Chinese are now afraid that they'll do the same to them, and they're getting rid of their bonds. So I believe a lot of the talk about dumping bonds is actually that they're failing to buy the rollover. They're failing to buy new ones. Janet Yellen and some other one from America went over to China begging them to keep buying. China knows that if there's a war, the first thing that'll hit is their bonds, right? So you understand that now. So I think I haven't done too bad there. I think I've explained that thing to you. There are British bonds as well. Oh yeah, there's one thing I didn't explain. There's one thing I didn't explain, and I'm just going to get the list here for it. Yes, and that's the currency value. Supposing now that American bonds for the 2 year, we take it, that's a nice handy bond, 2 year, wouldn't find that going around. And what I say it was there, well, I say it was 5%, we'd say it was 5%, okay, say that. Now, so they're 5%. Now, some big investment company in Britain sees that the local British bonds are only paying 4% and they want to get the 5%. So they decide they're going to go for 2 billion, or maybe 10 billion, or maybe 30 billion, or maybe 100 billion. They're going to invest. Now, one of the things I can't just clearly state, if the amount of money invested by the Japanese, the Chinese, the British, the Irish, and all of them is all public money, or is there a proportion of private money there? I'm a wee bit dodgy of it, but I think it's mostly public money. But there would be a certain amount of private money fund managers. Now, we'll say the fund manager in regard to big Greenfield Investments Limited decides he's going to buy 2-year treasuries in the US at 5%. He has to get the dollars. So he gets 2 billion in sterling. He goes and he changes it for dollars. Therefore, he puts up the demand for the dollar and he lowers the demand for sterling. The dollar appreciates in value and sterling depreciates in value because the interest rate you can get on US government bonds is superior to what the British bonds are paying. And that drives up the value of the dollar, and currently the dollar is at a high exchange rate. The dollar is trading very well. whereas it's not necessarily sterling, it could be any currency. So as countries take their own currency and demand dollars and buy them, and somebody else takes their own currency at a less value, the value of the dollar goes up and the value of their own currency goes down. I wanted to make sure I could explain that to you. I think I have that. I have that fairly well explained, and I'd ask you to tell me what you think. What do you think? How are we doing? I feel like a bit of a lecturer here. But anyway, it's a bit of fun, like, really. So now I think that's everything. If I left that note, I'll get it again. I hope to come back now to the real world situation. That's 15 minutes. I didn't do too bad there, so that you now know about the bond market and how it works. Yeah, like in the case of, we say, Saudi Arabia, they have so much oil that it doesn't appreciate their currency. They can use the oil. So they sell oil maybe to America. They get a big pile of dollars and then they invest in government bonds, and that doesn't affect their currency, but it does mean that the dollar, it has more value to it. It's adding value, because not only is it the currency of the United States, it's the currency of partly of Saudi Arabia and of all these rich countries, and that's why oil is such a central point in all of this. And that's not all in the possession of the West. The other thing then is gold. That's another valuable item that can be used as well. Now, hopefully now I've explained that about the inversion of the yield curve, when it goes like this, when the short-term bond yield gets higher than the long-term bond yield. When the long-term bond yield, when the interest on a long-term bond is less than the interest on a short-term bond. So folks, that's it. Give me a thumbs up or a thumbs down. I'll see what I'll do. I might do another one on some of the trends that are there, and I hope I've explained that fairly well to you. Thank you very much. Bye bye.